Hello, everyone. We will start in 5 minutes. We'll just give some time for everyone who's left to join. And in the meantime, feel free to introduce yourself in the chat, to talk about what you do, to talk about your approach to global investing. So, yeah, it's another 5 minutes or so. Daria, will I be able to see comments on chat? Not sure if that
Should be
setting is
able
there.
to. Yes, yes. Otherwise, I'll read out for you.
Yeah. Just to test it,
I can ask everyone to send to.
can you see people's comments in chat?
Yes. People are
So
saying that.
the option for them to click on chat with everyone, that is disabled. So they can message us directly, but I think you should just check on the WhatsApp group. Some folks may have gotten their invite sent to spam or not received it. Just check, call them up if necessary, and make sure that they're able to access the webinar.
Yes, yes. I'm helping them out.
Okay, I think we would have more or less added most of participants, and obviously anyone who's left can join as we go along. Daria, if everything is ready from your end, we can start.
Yes, Neil, we can go forward.
Fantastic. All right. So welcome everyone. Before I get into the presentation and also the Q&A, so this session is of 2 hours, double what we normally have because there are a lot of questions. A lot of you have sent questions in advance, and I want to cover as many as I can. Um, but I think there will still be questions which we won't have time to answer, or it could be some questions that we don't know the answers to right away. So what we will do, at the end is announce the concierge service and through that address the questions. Then we'll do individual calls with whoever among you is interested and take up those questions at that time. So before I get into the presentation, let me first introduce what we at the Fine Print do. Some of you, probably most of you, are familiar with me and my background, but let me just quickly recap that as well. So I was with the Mint for 6.5 years, from 2019 to August of 25. And before that, I was at different places. I began my career with value research, always worked in personal finance. Um, I've always wanted to help people with their personal finances, and this area in particular is of huge interest to me. Um, I left Mint in mid-August and joined FinRight, which was an existing startup focused on provident fund withdrawals. But the idea was much broader. It was to solve the hard parts of finance one by one, not just PF. So although PF does remain the core business even now, we also offer wills and estate planning. Um, so we've tied up with a law firm and we help people to create wills. Some folks who had a demise in their family, we help them locate all the documents and deal with transmission. So that's the second thing that we do. And global investing is the third, because we see this as a major unsolved pain point. Um, Largely, the financial industry in India only talks about the domestic market. There is very little expertise when it comes to overseas investing. And there were mutual funds historically, but since 2022, they have all hit the RBI limit. There are still some of them open, and I'll explain why. But they're no longer the easy, no-brainer uh, route to global investing that they once were. And therefore, one has no option but to study this a bit more and figure out an alternative that is best suited. So, with that, I'll just share my screen and get into it. In the meantime, Dhairya, if we can enable folks to put their questions, comments in chat so that I see them as I'm speaking, and of course, I'll address them once I'm done presenting. But it's nice to get some inputs even while I'm speaking.
Yes, Neil, that is activated already, so you can see that.
I'm not sure if people can um, put that in the group though. I mean, I'm getting individual messages, but
Okay,
I'm
let me
not
check
getting
for that.
any.
We can start till then.
Yeah. Okay. Cool. So I hope my screen is clearly visible.
Yes, Neil.
Okay. So global diversification is, as the name suggests, about diversification. Nobody, and that includes us, is saying that uh, one should not invest in India. As Indians, India remains the core of our portfolios. Of course, those of us who are NRIs among the audience, their country might be the core, or the US might be the core, but by and large, for Indian residents, India will remain the core. But it still makes sense to diversify, to have some allocation overseas for a number of reasons, and I'll go through them one by one. So this chart by ET Wealth gives the returns in Indian rupees of different markets in different years. I hope it's clearly visible. Otherwise, I'll try and zoom in a bit if I can.
This is good.
This is good, right? So if you start from the year 2016, Brazil was at the very top and India is at rank 6 with a 2.8% return. Many people here won't even remember that year, but it was pretty bad for the Indian market. 2017, India rebounds, goes to the top. 2018 again close to the top. 2019 Germany takes that spot. 2020 we're in fourth place, and so on and so forth. There is a constant rotation of markets in different years, and it's important to take note of this because when you have different markets, your portfolio does not jump up and down as much as a pure India exposure does. Your portfolio gets cushioned by that overseas part. Now, this chart is actually quite conservative because they have not considered Nasdaq or even S&P 500 as the index for the US. They have considered the NYSE composite, which has given much lower returns. So if we were to consider the Nasdaq or the S&P, actually US would be in first position and not Germany. But be that as it may, the broader point is that diversification has helped in different years. Different countries have been at the top. Now, the easiest route to diversification has been simply investing through mutual funds, right? Mutual funds investing overseas have been around since definitely 2008 when the RBI limits were set. And India's had mutual funds tracking specific countries, specific regions like Europe, or even themes, global themes. The most popular, by far the most popular fund for overseas investing has been the Motilal Oswal Nasdaq ETF. And I have a bit of a personal memory with it because I had asked my dad to invest in it in 2012, to invest 5 lakhs into it. And since then, it compounded in ways that neither of us dreamt possible. Um, Now, I think that investment would be around 90 lakhs in his portfolio. Just that one small 5 lakh investment. So, um, so it's been a pretty tremendous ride. I'm not saying that US tech stocks are therefore the place to be, but they are an example of what can happen, how you can leverage global investing. Now, what has happened with mutual funds is that they hit the RBI limit in 2022. Yet many of them are still open, and we are going to put out a list of those at the end of this session. When we send out the mail with the recording and other things, we'll send you a guide also. That guide has that current list of mutual funds which are open. So you might wonder, why are they open? The answer is very simple. SEBI has given a dispensation to mutual funds that if there are redemptions or if for whatever reason your individual limit has not been hit, then you can continue to accept money. So you have this phenomena of mutual funds opening and closing. It's like a local train. Somebody gets, or a bus, somebody gets off, there's a bit of space, and somebody else gets on, and then it again stops taking people, passengers, um, and so on. So it's not a great option anymore because of this. So on social media, a lot of these lists are floating around of mutual funds that are still accepting money, and they are deceptive because they will soon close, many of them, or many of them have limits that are so low that it doesn't make sense. So Edelweiss, for example, allows SIPs, but only 5,000 rupees uh, per month, which is not going to make a difference to most large investors. So it's a kind of deceptive list, and it is there for those who really are retail investors who can't take that effort or the cost of diversifying into a gift fund or into opening a US broking account. For them, mutual funds are perfectly fine because they don't need that much quantum anyway. With Motilal, what this chart shows is that this cannot close. So ETFs like Motilal, they cannot close by design, by definition. But um, because supply is lower than demand, because it can't create fresh supply, because it can't buy any US stocks, you have a divergence between the price, the traded price, and the NAV. This divergence fluctuates. Sometimes it's not there, sometimes it's a discount, sometimes it's a massive premium. It really depends on a lot of idiosyncratic factors. sentiment and so on. But structurally, it's not a great way to approach US investing anymore, because you will not get the fair price. You will be charged a premium by the market, because when you're putting in money, you're buying units from somebody else, from another investor, not from the fund house. And that other investor is going to charge a premium. So that's the problem with the easiest route. I wish this were not the case. I totally get a lot of you have expressed sentiment that why don't they just increase the mutual fund limit? And I went and asked the RBI governor himself, the last RBI governor, Shaktikanta Das, at a Mint event, and he just said that something vague about the time, when the time is right, we'll do it. But it does not seem like they want to do it. And I don't have too much hope that they'll do it. So this is how things stand with mutual funds. Uh, this slide kind of illustrates the same point. I took this screenshot today at a particular of time, so it might have changed a little bit from this price now, but it's at a 5% premium compared to the INAV, and this you can see on the NSE website itself. So the premium fluctuates, as I said, the blue and the green lines. This is from Value Research. They keep changing, um, but it's generally there, and generally you won't get a fair price. Now, the rupee, of course, has been foremost in our minds of late. It makes the headlines when it depreciates rapidly, but truth is it depreciates consistently, has done so since independence. This is the table is from the RBI, the average INR to USD exchange rate, and at independence it was 3.3 um, to the dollar, 3.3 rupees to the dollar, and now touching 90. In our history, I mean, a lot of people say to me, what if I invest overseas and the rupee appreciates? And of course, it will. In the short term, there are periods when the rupee has also appreciated. There are periods when it has remained static or stagnant against the dollar. And then there are sharp depreciation, right? This is not a compound interest formula. This is the market. The market moves, in random ways. But the long-term trend has been intact since independence, and I don't see a very strong chance of that going away until some massive macro shift happens in the world, even with the dollar depreciating. So a lot of us have been following the headlines around de-dollarization, and it is happening to an extent, but for whatever reason, the rupee has not been a beneficiary. So if you look at how the rupee has done against the euro, for example, or the British pound, in the past year, actually, the rupee has fallen much more, in double digits against the euro. And the pound, I think, I forget exactly how much, but 7, 8% possibly is the rupee fall. So it's worse than how it has done against the dollar. So dollar is depreciating against other major currencies, but rupee is depreciating even more against other major currencies. So this whole thing about de-dollarization and we should not focus on the dollar, actually focusing on the dollar is hiding the true extent of rupee weakness. Now, why the rupee is weakening is a detailed macro discussion. Um, and maybe one day we can schedule a talk with an economist for it. Um, Essentially, a recent panel that I was at with Saurabh Mukherjee, he summed it up. He said that India historically has had a trade deficit. We import more than we export, and a current account deficit, therefore, but a capital account surplus, meaning that we finance the trade deficit by importing capital, by taking money from the rest of the world, by borrowing it in terms of either debt or equity. And that, because of FIIs leaving India, that capital account surplus narrowed, went into deficit as well. So we had two deficits. And when that happens, the balance of payments stops balancing and you have a rupee depreciation. So, um, long story short, the rupee balance of payments has not done so well. And while I don't know the future, there are no immediate reasons to think that it will magically improve over the next few years. It might be flat, it might be stable after this year's painful depreciation, but whether it'll go the other way or not, there are no major indicators that it will. Um, I always like asking this question in events I go to, but since you have the answer here, the question is, in what year did the rupee depreciate the most against the dollar? And most people say 91, some say 2013, and those were also years of rupee depreciation. But actually, it was in 1966, 6/6/1966. That was the date when the rupee was devalued from 4.7 to 7.5, a 56% devaluation. Now, the Times of India from the next day says 36.5 because they've calculated it on the wrong denominator, but actually it's a 56% devaluation. And imagine that pain, right? One day you're worth X in dollars, the other day you're worth half of that in dollars for no fault of yours. And I think this is especially painful for NRIs because in NRIs uh, minds, because they live in the West, their base currency is the dollar, it's not the rupee. So suddenly imagine you have $50 worth of assets in the US and $50 worth of assets in India, and that India 50 gets cut to 25. Like just imagine that net worth loss. So so it's a painful thing, and it's been so for a long time. Now, the other reason why one should diversify abroad. This is my favorite chart. What does this chart tell you? It tells you, almost in Game of Thrones style, the rise and fall of nations. If you see the colors and the history that follows those colors, you see it, you see that drama play out. So if you follow me from the year 1900, the country with the largest share in the world market cap. So this is the world stock market, by the way. Um, the country with the largest share was Great Britain, GBR, at 24%. And you see that it has, over the next century, ever so gradually kept losing market share, kept shrinking, kept shrinking. It was a long but slow decline. The country that took its place, of course, has been the United States. But the United States has also had its ups and downs. So in the 1940s, you have World War II, United States slips a bit, then it revives, then again it loses market share, not because it does something wrong, but because Japan has a big stock market boom in the 1980s, and that collapses and so badly that the next decade and a half um, are ones of negligible returns in Japan. That trend of bad returns comes to an end only in 2012 when Shinzo Abe does a huge mega bazooka monetary loosening program, and Japan takes off, and it has been doing rather well since then, despite its economy being sclerotic, despite demographics being unfavorable. Usually, if you see mutual fund presentations, they have the same slide number 2 and 3. India. Why invest in India? Number one, demographics. Number two, government program of the day. So at some point of time, it was the um, Make in India program. At some point of time, it was PLI. Um, and now, whatever the latest scheme of the government is, they just copy paste it. Because unfortunately, the mutual fund industry does not have any familiarity with global investing. They're all trained on the domestic market only. That is their only, it's like a shop which only has one vegetable to sell, onions. So no matter how good potatoes are or carrots are or oranges are, it can't talk to you about those. All it can say is the onion smells good, looks good, please buy it. So that's the situation, unfortunately. And I hope that with Gift City, that complete lack of information, complete lack of analysis about global markets for Indian investors is remedied, is reduced, because it's not fair to us. We should be made aware of other opportunities throughout the world. So, just finishing off with this table, you might ask, where is India in all of this? Well, India is too small to matter. So, this is the UBS World Global Fact Book, and India is just too small at 3% to to even have a color here. So we are in a global small cap. Mind you, an exceedingly well-performing small cap. So there is no denying how well our market did from 2020 to 24, especially small and mid caps. But nothing lasts forever. No cycle, no boom lasts forever. And there's nothing more harmful in the world than to just look at 5-year returns of a particular mutual fund category and say that, oh, this is going to be replicated in the next 5 years. It's almost as bad looking at 1-year returns. I have said some of this already. India's allowed mutual funds for a long time. Indians who used that mutual fund route to diversify have benefited. But there has been a lack of discourse, a lack of advice, a lack of information. Because, as I said, the mutual fund industry is just not interested, just not trained. That's changing now with Gift City a little bit, tiny bit, but by and large, just not interested. Um, and that hurts us. That hurts us as Indians, as Indian investors. It doesn't help us locking away our capital into a single country. So, how do you diversify? As I said, domestic feeder funds are the easiest route. They are just like any other mutual fund. They have underlying portfolios which either directly buy stocks abroad or they in turn feed into other mutual funds abroad. The most famous one is Motilal Oswal Nasdaq ETF, but there have been so many. Mirai has Fang, Mirai has Hang Seng Tech, if I remember correctly. Nippon has Hang Seng. Edelweiss has a pretty popular Greater China fund. Franklin has ones tracking US, Europe, a lot of fund houses, a lot of options are there. But as I said, since 2022, the industry has hit its limits. So the very few funds that are open, they have very small limits left. And they are, as I said, a bus. They take people in when somebody gets out. And then when the bus is full, they stop taking more money in. So it's not consistent. You can't do a sip. Or if you do a SIP, they'll allow a very small SIP, like Edelweiss allows 5,000 rupees a month, which is practically nothing. Then there are domestic multi-asset funds, which in my mind are the best way to do it if you don't want options 3, 4, and 5. Um, because these funds cannot shut. All the fresh flows go into um, the domestic part of their portfolios. So you can have a consistently running SIP for a long time. Of course, the risk is dilution. What happened with Parag Parikh FlexiCap is classic case. It went from 35% global equity not that long ago. I think probably as late as 2020, they were at 35% global, 65% domestic, to 10% now, simply because so much money has come in. All that fresh money has gone into domestic assets, and therefore the share of global has just come down. Um, so that can happen. It probably will happen, but it'll take a long time. And some of these multi-asset funds have rather cleverly kept their expense ratio low on the regular plan, so they're not sold that much, and so they don't get filled up as fast as one might fear. So domestic multi-assets are a quite easy and sensible way of doing it for someone again who wants to just have a small amount of global exposure without too much effort, without too much trying to capture too much alpha. It's perfectly fine. Then there are, of course, direct stocks and ETFs. So you can open a broking account with one of the many players. And by the way, there's been an explosion of players offering this. Um, so one can open a broking account through one of these players and directly buy stocks and ETFs. I'll just recap some of the major players. We have a comparison table, so you can see that and make a decision as to who you want to go with. But broadly speaking, in this space, there is Ind Money, there is Vested Finance, there is a company called Pasa, there is a host of others who have tie-ups with them. Um, and of course, with Gift City coming in, then yet more players will enter. Zerodha has already announced that it has plans to launch overseas broking from Gift. So, oh, that reminds me, there's India INX GA as well, which is a BSE owned company. Most of these have tie-ups with US brokers. So uh, one of the US brokers that some of these are tie-ups with is Interactive Brokers. That is one of the possibly the oldest player with the India presence in this space. A very comprehensive platform. I've been using it for considerable period of time. Uh, Works quite well. The only issue there is that they don't customize for Indians, so they don't provide custom tax reports for Schedule FA. You have to download it and then yourself fill things into Excel and yourself take it to the CA, and then it's an effort for Indians. But other than that, I think their platform works reasonably well. Some of the other Indian players also might have better customer service for Indians because that is their focused market. Whereas, again, with Interactive, the whole world is their market. So India is a small part of it. Then there is Gift City Retail Fund. So DSP is the first and only operational one in an online sense so far. And I tested it out. So I put $5,000 into the DSP Global Equity Fund, not because I am in any way recommending it or it's a big pick for me, mainly because I wanted to see the process. I wanted to see how it pans out. So I put the bare minimum, $5,000, and it was very seamless. I was able to do it literally lying down on my bed in 10 minutes, the entire KYC process. So DSP has tied up with IndMoney, and here it's very important to understand the distinction. The IndMoney tie-up is only for IndMoney to do the KYC and the remittance part, just the process part. So if you go through the DSP IFSC website, you do not become a customer of IndMoney, although IndMoney will do your KYC and will provide the pipeline for your money to go to Gift. Um, so so you don't have to be their customer, and then you can buy the direct plan, not the regular plan. So that's what I did. I went to the DSP IFSC website, and in fact, just today I got my second monthly statement from them. Um, so yes, so retail funds and Gift will be an interesting play. And by the way, DSP has two very seasoned fund managers, Indian fund managers who are running it, or other fund advisors, as they say. I met them both at the DSP head office, and what is encouraging, what is nice, is that we have Indian talent now for the first time managing money across the world, something that we could really leverage for in so many ways that we haven't done so far. Um, Gift City AIFs, there are so many. There are so many AIFs which invest overseas. Everything from thematic exposure. So, for example, BNP Paribas launched a US small cap AIF to something around precious metals. So, for example, there's an AIF called Rational Asset Management, which does gold miners mainly and a bit of silver miners, listed in Canada and some other geographies. And they've done quite well as well. Very independent guys, very interesting story. If you want to know more about them, please do follow our channel on YouTube, The Fine Print. I've interviewed many of these guys, talked to them in detail about their strategies, and we intend to do so for all of the major players. So, for example, Edelweiss is waiting in the wings. They will soon launch a China fund in Gift, which will be a lot like their existing Greater China Fund. In fact, the same strategy. So we'll provide you some details on that when that becomes operational, and there'll be many, many more coming out. Um, so most of this I've already said. This slide just summarizes what I said earlier on onshore feeder funds. This is the current list. This list keeps changing of which funds are open, and don't worry, we will make this part of our guide. So we are releasing a proper guide on global investing, which will get mailed to you. So this will be part of that, and we'll keep updating this whenever there are openings and closures, which keep happening every few days into these funds. This is the list of hybrid funds. So as I said before, I personally prefer hybrid funds a bit more for global exposure because they can't open and shut. They just see a slow dilution of the foreign exposure, and that hasn't really happened much in them. Probably because many of them have a very low expense ratio, so nobody's selling them out much. So it's a pretty easy and nice way of getting global diversification, especially the ones that feed into ETFs, because that's you take away the risk of active stock picks going wrong. ETFs give you a pretty broad exposure to various markets, to various themes. So as I said before, US brokers like Interactive Brokers have a presence in India. You can open an account there under the LRS of the RBI. So you can remit up to $2.5 lakh per year under the LRS. And above 10 lakh, there is a TCS of 20%. So that 10 lakh is for all kinds of spends. You go on a holiday, you pay educational fees, whatever else you remit money for, that's all counted towards both of these limits, the 10 lakh limit for TCS and the $2.5 lakh uh, for for the overall LRS. Again, TCS is nothing to worry about. It's just a collection of tax. It's not a fresh tax. You can adjust it against your advanced tax liability, or if you have already paid too much tax, then you can claim a refund when you file your ITR. It's really not that big a deal. Um, the other thing to keep in mind is LRS also applies to GIFT City. So even though GIFT City is inside India from a geographic point of view, it's near Ahmedabad. It is an SEZ, and it is outside India from a foreign exchange point of view. So, so these two taxes will apply to remittances to GIFT City also. The good side is that GIFT City is inside India from a income tax point of view. So the tax compliance for a GIFT City fund, if you hold one, is much lower. You don't have to fill Schedule FA. Um, and that's one big advantage that GIFT City funds have. The other big advantage is that US estate tax does not apply if you hold GIFT City fund units rather than directly owning US stocks. Now, I want to spend a few minutes on US estate tax because people do a bit of scaremongering on it, blow it out of proportion. It only applies if you have assets in the US in excess of $60,000. Not 1660, $60,000 उससे ज्यादा अगर आपके एसेट्स है यूएस में, तभी आपको यूएस एस्टेट टैक्स लगता है. And that too, it doesn't hit you, it hits your family upon your demise. So you are thinking ahead to your own death and what's going to happen to your family. The amount of worrying and obsession that happens on estate tax. I mean, if we were that worried, most of us would have our wills done already. But you will find that we are not bothering with making our wills, but somehow when it comes to estate tax, we all get our skirts in a bunch. So one has to be a bit rational about estate tax. Yes, of course, it's an issue, but it's only if you want to build that high a balance of assets in the US. So again, as I said, a gift city fund is a solution to US estate tax because in that case, you are not directly holding units in the US, you are holding gift city units in India. So you don't have to worry about it. UCITS is the other solution. So UCITS is a kind of fund which is domiciled in Europe, typically Ireland or Luxembourg, and they invest in underlying assets which could be in the US, which could be in Europe, it could be anywhere. The only difference between a UCITS fund and a US fund is the domicile, the location of the fund. Of course, UCITS funds do have a higher expense ratio. So this benefit of estate tax does not come free. There is no free lunch in finance. So if you do go for a UCITS fund, you will be paying out more money uh, as opposed to a out and out US ETF. So everything is a trade-off in life. There is no one size fits all. You have to take a call basis all of the pros and cons. This is a comparison that we did about broking apps in the US. Uh, we've given you some examples about if you had bought so many shares, how much you would have paid in brokerage, etc. Apart from brokerage, a lot of anxiety is placed around currency conversion. And I get where it comes from because currency conversion through the rack rate or the card rate that banks apply is indeed expensive for small amounts of money, if you remit like $100, then you might find your remittance costs balloon to 5 or 10% because banks have certain fixed fees also. But if you remit higher amounts, and usually you should do this if you are willing to remit at least $5,000, उसके नीचे करना आप कर सकते हो, but it's not going to make a meaningful difference. So after that threshold, then you get the ability to bargain. There's two ways of bargaining. Number one is you call up your bank, your branch RM, and you say you want a better rate. And then you can leverage anything, your existing relationship, your the size of the remittance, various there are various ways to negotiate, and usually they do reduce because banks earn such a nice fat spread that they reduce. Second one is many of these brokers like IND Money or Vested have tie-ups with banks. So when you go through their channels, they've already bargained down the rates for you. And so it's not a usually 1 to 2% is what you face. And a lot of people say I'm paying 2% one way, 2% the other way. Isn't that 4%? That's horrendous. How can I possibly do this? Which is a very silly argument because nobody's asking you to remit money in and out of a US broking account in a month or even a year, right? The idea is buy and hold. This is not designed for an SIP out of India every month. That's just not how it's designed. So yes, you might perhaps face a 2% conversion one way, but typically you would then be remitting your money back after you've made a decent sum of money in returns, probably ideally after 5 years because equity needs 5 years to compound. And by then, the extra 2% would be meaningless. By then, the rupee would have depreciated against dollar quite a bit. Your underlying portfolio would have done its thing, given you whatever returns that you would have got. If you're lucky, maybe 10-12% kind of returns. And so it's a meaningless charge, this 2%. So it's nothing to worry about, honestly. Um, but it's good to know how much people do charge, and therefore we've compiled this table. Now, a lot of people have ESOPs or RSUs, restricted stock units abroad, and these are essentially people in India who work for MNCs, and they get this as part of their salary, as part of their compensation. And for a lot of people, it has made them millionaires and multi-millionaires because many of them work in tech companies in the Nvidias of the world, and they've done extremely well for themselves. But it has also created a risk for them because suddenly the allocation to a single company, which is their employer, has gone from whatever 5-10% of their portfolio to 50 or 70 or 90% of their portfolio. And as everyone talks, the tech bubble can crash. There are good chances. And suddenly you will face a net worth wipeout of a big, big magnitude if you just let things be as they are in a ESOP or RSU. So the sensible thing to do is to pull out some money from that ESOP or RSU and put it into a fund. You can either do it into a US fund, a diversified US fund, or into a UCITS fund if you're worried about estate tax, or number three, into a gift fund. Now, the pipelines to a gift fund have not yet been built out. So, from our understanding, you can't today transfer money from a US broking account directly to, let's say, a DSP. I don't think they have enabled that yet, but it's a matter of time. The other option is to open a gift bank account. These have been enabled for resident Indians, but banks are somewhat slow in offering them. They don't talk about them much for one main reason that the RBI has a rule that if you remit money in dollars outside and you don't utilize that money in 180 days, 6 months, then that money has to come back to India. Meaning that either you have to use that money. So if you have remitted that money for buying a stock or an ETF, you have to actually do that in 6 months, or you have to bring the money back. So this means that people will not retain idle bank balances for too long in Gift City bank accounts. And so banks don't have a stable pool of money to lend against. So this diminishes their interest um, in asking people to open gift accounts. And so you don't find, I mean, it's very difficult to get a bank to talk about the gift account. But yes, they are offering them. It's not unheard of. Some people have opened them. And I've heard that there are talks with Visa to enable cards also. On the NRI side, by the way, a lot more has happened. So as we did a story about NRI from Oman recently who uses the gift bank account for many things, for investing into the IBKR account that he has, or for his son's to pay his son's credit card bill in the US. So those are well and operational, and they're offering high interest rates. IDFC First and others are offering 4.5, in one case 4.75% in US dollars, which is huge, huge. It's double, almost triple what banks in India are offering on savings accounts in rupees. So NRI part of it is very operational. Resident part of it currently is not, and the bank accounts so far that we've heard of, they're not being interest also. So all I can say is watch this space. I think in another 6 months, there will be a set of providers who will offer bank accounts, who will find a solution to the 180-day thing. It's just a matter of putting some effort into it. So there we have it. A usage fund or a gift fund will protect you from US estate tax. This is a compilation of Gift City outbound funds. These are all AIFs. Ionic has an interesting play where okay, so there are two kinds of outbound funds. One, like DSP, which do the churn themselves in gift and therefore can attract 42.7% tax. Because in Gift City, the taxation is at fund level, not at investor level. So when a fund like DSP buys and sells stocks in the short term, it can attract 42.7%, but of course, they will minimize this, right? They're not crazy. They don't want their investors to have a bad experience. So it is there, but it may not actually be a major issue. Um, and of course, after 2 years, then the tax is 12.5% plus surcharge and cess, which comes to 14.95%. Again, not that different from what you would pay anyway in India, which is also 12.5% plus surcharge. So that will take it to 13 plus, sorry, 12.5 plus cess, which will take it to 13. And surcharge may apply to if you're above 50 lakhs in income. So that surcharge part is a bit of a differentiator, but it's not that much. It's 1.5%. Now, as I was saying, these are the AIFs. So other AIFs like Ionic, for example, they don't do churn in the gift side. They just feed into a master fund in Cayman Islands, and the churn happens there. Parag Parikh also, and I'll come to Parag Parikh in a minute, does this. They feed into a UCITS fund, if I remember correctly, either in Ireland or Luxembourg, and the churn in the stocks happens in the UCITS fund, not in the gift fund. So they don't have to face the taxation that can happen due to churn. And these are the other strategies out there. Marcellus, Aditya Birla, Rational. Rational is quite unusual. They have this gold AIF, gold miners AIF, BNP Paribas, US small cap, Mirai in ETFs across global markets. So already quite an interesting selection. Oh, and quick mention. So Ionic also has this accreditation feature where if you get accredited with them, meaning that if you have more than $1 million of net worth, then the minimum ticket size drops to $10,000 for their fund. And I'm sure others will do the same. So it's just a matter of time. These are the retail funds in Gift City. So these have $5,000 as their ticket size. DSP, of course, I spoke about. It's diversified across the world, 40% US, 32% EU, rest in Japan, China. Um, this is 30 to 50 stocks and across themes, across geographies. The DSP portfolio is not fully deployed, which is why if you have invested in it, you will see that a lot of it is still in cash or debt, etc. But it's getting deployed out. Parag Parikh recently got approval, and they just very simply passively track the Nasdaq or the S&P. through a UCITS ETF. So the churn happens in the UCITS ETF. Um, Very simple to understand. These are gift funds. You can remit $5,000 to them. Currently, the online process is not enabled to Parag Parik. Offline, yes. So if you have a distributor who's empaneled with Parag Parik, as we are also getting to be, you can invest through us. You can invest through your distributor, whoever you choose, into these funds. Uh, just a bit about how what GIFT has for resident investors and NRIs. I went over this already, but this is a nice reckoner of um, what the various rules are around tax, around LRS, etc. Quick points about LRS: through you can't invest in leveraged ETFs, you can't do leveraged trading overseas, and you can't do crypto, you can't do crypto ETFs. So keep that in mind. Finally, advantages of GIFT City versus the other options. So number one, no US estate tax. Number two, no Schedule FA reporting. And it is a difficult thing. Schedule FA is complicated, so it's not a trivial problem. It is a big relief to not have that. And number three, regulated Indian players under an Indian regulator, under IFSCA. So if something goes wrong with your fund, you don't have to figure out which regulator in Luxembourg or Ireland or Cayman Islands or US or Europe to complain to and what their redressal mechanism is. Your guardian is sitting very close by in Ahmedabad. You can much more easily access consumer protection there. And because Government of India is keen to develop Gift City, I'm sure they will do their best to minimize any kind of wrongdoing or any kind of negative outcomes for investors. So I think, okay, so this is a quick aside on how I invest. Lots of people keep asking me in the group, so I thought I'll quickly go over it. I'm not saying this is what you should do. This is not a recommendation. You don't have to follow me. I'm just telling you what I do uh, as one of the many inputs that you should take on how to invest abroad. So I'm not super keen on US valuations, which is why I invest in ETFs of emerging markets. So these are all ETFs tracking emerging market uh, economies, countries. So EWW is Mexico, EWZ is Brazil, EIDO is Indonesia, VNM is Vietnam, VDE is US energy. So think of ExxonMobil, think of Chevron, uh, companies, oil explorers that you won't get in India because India does not have a lot of oil. And they have a pretty good dividend yield. I have different reasons for buying each of these. Brazil, for example, has very high interest rates, and a virtuous cycle of interest rate cuts could propel their stock market much higher than where it is currently. It's also indirect play on China because Brazil is a big exporter of various things to China, without the risks of the Chinese communist system. So I have reasons for buying each of these. I've done some bit of research myself. EWY, by the way, is Korea, South Korea. It's a indirect tech play because it is connected to some of the US major tech majors and the spending on AI. Um, so yeah, last year has been pretty great for my portfolio, um, but not all previous years. So there have been times when India did much better than the global portfolio, right? So global doesn't always work. It just has done last year, and this may be the start of a big cycle, a shift to some of these other markets like Brazil, or it may not be, right? I don't know, but by being in them, at least I am hedged. At least I have some allocation there. Um, so yeah, this is the contrast. So in 1 year, Brazil is up. Just an example, not a recommendation, just an example. Brazil is up 34%. But if you look at 5 years, it's not up much at all. And it's a lot cheaper than India. So the way to do some research on this is at a macro level is to look at the MSCI fact sheets, country fact sheets. They tell you the PE ratio, they tell you the earnings, various things. Also, the ETF has a fact sheet. And so if I think of it as a value buy, then Brazil is attractive. If I think of it as momentum, then again, Brazil is potentially attractive. Again, I'm not an expert. I don't know, but I've been doing this for a while. I have done my research. And so, touch wood, this will work out for me. Now, finally, what we're going to launch, what we have in mind with the fine print. So, because this is so complex, it's not as simple as click of a button, open a demat account, click of a button, buy your Nifty ETF, and you're done. Even that part, even domestic is not simple, but it's somewhat simpler to the global side. In global, you have to take into account a lot more other variables, the LRS rules, the forex costs, the taxation, which option to choose, gift or broking or just a plain vanilla mutual fund. There's a lot more complexity. So the concierge that we are launching is a service where we have a call. One of my team has a call with you to understand your preferences, your circumstances, and give you the information that you need to equip you that so that you make the right decision from an authoritative source. We've been studying this for a while. We know our stuff. We like to think that we're one of the few people in India who do. And so we can guide you properly. A lot of people ask stuff in the group and sometimes other people reply and the replies are not always accurate. And I may not spot that in time. And I don't want people to get wrong information. So the best way to ensure you don't get wrong information is to talk to us directly through the concierge service. We are not charging anything for this at present. However, we may have tie-ups with, for example, Gift City Funds or with a broking partner and be a distributor in that sense. But we are neutral. You can choose any option, Indian mutual fund, Gift City, broking partner. We're not going to say this is better. It all depends on what suits you and your circumstances. So, so yeah, this sums up what the concierge service is for, and hopefully, please do use it. What we will do is allow you to book calls um, in the mail that we send out. So after the session, we send out a mail with our guide and the recording and stuff. So we'd like you to use that link to book a call. And I think Dhairya will also put the link now as I'm speaking so that you have it handy in case that mail goes to spam or you're not able to access it. So that is the idea. We hope to build on this further and launch at some point our own platform for global investing with added benefits in terms of tax reports, in terms of research, uh, because this is an area that is of so much interest and so much focus for us. So that's it from me. Um, Again, we will not give any advice on securities in India. Um, we are in the process of getting an RI license. So on the domestic side, if you're interested, you'll have to wait a few months, and then we can talk to you about that. We are already a distributor, so if you invest through us, that's not an issue. But if you want advice, then we'll have to wait a few months. So yeah, that's it from me. Happy to take questions.
Yeah, thank you. Thank you so much, Neil. I'll move on to questions. If you want to have a moment before that, what please?
I'll have some water.
Yeah, sure. So I'll first move to the questions which were asked on email and maybe then move to the questions which are in the chat box.
Yes.
Okay, so the first question on email is from Ganesh Sharma. Question is investing in usage through IBKR better than investing in upcoming GIFT City funds? Considering the long-term investment horizon and tax implication, which option will give us additional advantage in terms of long-term retirement corpus accumulation?
So as I said, it is a personal decision. Different people are sort of weighing different factors differently. So what I mean by factors is the advantage that Gift City has over an IBKR, even a UCITS fund in IBKR, is twofold. Number one, there is no Schedule FA reporting. So it makes your tax compliance a lot easier. the tax is paid at fund level, so you don't even have to account and pay for advance tax. The money that you get on redemption is essentially exempt income. The second advantage of gift over usage is that you have an Indian regulator and you have an Indian ecosystem to explain things to you, to redress your grievances. Let's say that some issue happens with your usage ETF. Now, you can't very easily go and complain to some AMCs sitting in Ireland and know their procedures, right? Whereas if it's familiar name, if it's a DSP or an HDFC or an ICICI, they're a lot more accountable to you because they have to be. They're accessible to you as an investor. So these two things give me a lot of comfort with Gift, but it is a personal thing. Some people they want to save on costs and they want more choice. So Gift is just getting built out. There are limited options right now. So if you want more choice, then an IBKR could be better. So it's a very individual decision.
Yeah. So next question is from Tejas. Uh, Starting knowledge in international investment to retail guy, Pareto principle, and who is the right candidate to invest, who should not in global investments. So principally, the question is who should invest globally and who should not.
Yeah. So in my view, although everyone should invest globally for very retail investors. So let's say your portfolio size is just 25 lakhs or 30 lakhs, right? You're in the start of your career or you've just finished a few years of work. It may not make sense for you to go to Gift City necessarily or to go to US broking account unless you have a keen interest in picking stocks and ETFs abroad. If you're just looking for some basic diversification, then you will get a reasonable deal through mutual funds, even in the current state that they are, maybe through a multi-asset fund. But above that, I think you should seriously look at either Gift City or US broking account, depending on where your preferences lie.
Okay. So the next question is from Anuj. In terms of Indian mutual funds that invest globally, does it make sense to invest in a fund that no longer invests abroad, but still has significant international exposure like ICICI Pro Passive Multi-Asset Fund, or in the fund that still can invest abroad like DSP Global Innovation Overseas Equity Omni Fund of Fund? Please give suggested rates for both categories of funds for Indian mutual fund investors who want international exposure.
Yeah. So, as I said before, multi-asset category is quite good for this because they don't open and close, and they're not seeing a lot of dilution of their overseas exposure. I'm not going to take specific names uh, for that. If you want to invest through us, we are a distributor. That conversation can be had. But suffice to say that this category is quite good for this purpose, multi-asset funds.
So the next question is from Chandramani. Is there possibility to open a saving account but having USD as currency? Also, can I have interest on savings? I work and earn in India only. And the second question is best way to invest in global mutual fund. Kindly suggest some honest guys like PPFAS.
Okay. Um, so on the first point on US bank accounts, banks are offering them, but as I said, somewhat reluctantly. They are not pushing it because they are not able to keep the money for a long period of time, right? 180 days. So, so I would say wait it out a bit. Fintechs will also come into the play. They'll innovate, they'll create wallets, they will create better incentives. Most banks currently are not offering interest. They're opening current accounts for individuals also in gift in US dollars. So you can do it, but it's at a very infant stage right now. So unless you have an urgent need, wait a bit. We are also talking to banks in gift. We're also talking to fintechs. We're trying to figure out a good solution to this. So as soon as we are satisfied with one, we'll definitely inform you about it. On trusted names for invest. So as I said, that's what the concierge service is for. We are going to be empaneled with Gift City AMCs and Indian AMCs. So we'll have a better discussion with you on that.
So next question is from Gurpal. A bit long question. So first question is Schedule FA reporting rules. Do we use March 31st or December 31st for valuing assets in Schedule FA?
Yeah,
Assets to
so
report,
hmm,
sorry, do we have to report only assets held on March 31st or must we also report assets that were held and sold during the financial year? And next,
yeah,
with respect to reporting, is can we club multiple RSU vestings received on different dates into one Schedule FA entry? Use an average
okay,
price and mention just one acquisition date.
okay. So as you rightly said, this is a very complicated area. Schedule FA follows a calendar year system. So you generally report it for 31st December, as on 31st December. But for your tax calculation purpose, you have to follow the Indian financial year. It's silly, it's complex unnecessarily because you're doing both. You're also reporting from a financial year perspective from your tax calculation, but you're also reporting from a calendar year perspective for Schedule FA specifically. And apart from FA, there's also Schedule FSI, which is foreign sourced income. So if you have made capital gains or dividends, you have to put it there. If you have withholding tax from the US, you have to claim that in Schedule TR, tax relief. So it is complicated stuff. Ideally, you should use a CA. And as part of the concierge service, we will connect you to a good CA who's specialized in all of this. So, um, so he can give you the proper guidance that you need.
So next question is RSU sale proceeds. Is there any RBI or government rule that explicitly allows us to reinvest RSU sale proceeds overseas without bringing the money back to India?
Yes. So, per my understanding, there is no reason for you to bring the money back to India. You can reinvest it in 180 days. You have to just comply with the 180 days rule on idle funds.
So next question is, do GIFT City funds deduct tax long-term, short-term at the highest slab rate, which is 14 and 42.74, even if individual investor is in a lower tax bracket?
Yeah, that's the unfortunate part. So, because taxation is at fund level, they don't take into account your individual tax, which is why some of the Gift City funds have created superior structures, like Parag Parikh has, which feeds into a master fund. So, it does not have to deduct tax because of churn. It does deduct tax when you redeem, but if it's after 2 years, that will be 14.95%. So yes, you could be in a slab which is lower than 14.95%, but in most cases you will not be. So that's an okay rate to face tax at.
Next question is, which type of banks or service providers offer the best conversion rates inward and outward for global investment?
So in our experience, there is no one particular bank. As I said, there are two ways of getting a good deal. One is to call up your RM and negotiate a bit. The other is, and especially negotiate if you have a higher amount that you're remitting. So don't think of remittance as like I will do an SIP every month. Think of it as I'm going to do this much for the year. And anyway, I have 6 months according to RBI rule to deploy it. So ऐसा नहीं है कि आज रेमिट किया तो कल सारा इन्वेस्ट करना है. आप धीरे धीरे कर सकते हो. So yeah, so you can talk to your RM and get a better deal. Second option is if you invest through a fintech, and one of the things that we will do when we launch the platform is also create as low a remittance, as low a forex spread as we possibly can. But until then, there are existing fintechs who, like InMoney or Vested Finance, who anyway have created that for you as a user.
So next question is from Rajiv Kumar. Context is, I'm an NRI based out of UAE. For this persona, the questions are, could you suggest some of the global ETFs with usage compliance for NASDAQ, S&P, ex-US market?
Yeah, so again, please do book that call with us on Concierge, and we can have a more detailed discussion specific to your circumstances.
So next question is, what is expected launch of PPFA as GIFT City Active Fund for Global Investment? Will it be applicable for an NRI?
Um, so outbound funds are not prohibited by the RBI from accepting NRI money. DSP already does. Parag Parikh active, as in the retail active fund, I think will take 6 months. It is in their roadmap. They are working on it, but it takes time to get all the approvals and all of the pipelines into place. So I would give it 6 months. Um, and I don't think they will stop NRIs from investing because DSP has not. But again, we'll have to check with them on that.
The next question is, do Vested Finance India platform allows registered NRI users to subscribe DSP Global Equity Fund via GIFT City? What is the cost-effective way to transfer USD from UAE to India?
Okay, on the first one is I think it's a vested finance specific question. So we will have to check with them and get back to you. Again, if you book the concierge service, we will do that for you. Second one on UAE India, Forex providers. Again, you can leave that with us. We'll do some research and get back to you.
And follow-on question is, do opening of GIFT City bank account and then transferring fund to DSP via GIFT City is cost effective if an NRI is investing in DSP via GIFT City from Vested Finance Indian platform? Do one have to declare foreign assets while filing income tax return?
If you are an NRI, then you don't have to declare foreign assets. Schedule FA applies to resident Indians.
Okay. Next is, do digital KYC facility available for an NRI to subscribe directly from DSP GIFT City for DSP Global Equity Fund via GIFT City?
Yes, yes. So if you're a resident Indian, then KYC happens online entirely. So you have to just go to the DSP IFSC website and they use InMoney to do the KYC. You don't become the InMoney customer. They just do it for DSP and you can invest. I did it myself.
The last question is, if an NRI is expected to return, say, after 10 years to India, which one is better suitable if one subscribe Indian-based partner for global investment versus a UAE-based platform like Interactive Brokers of UAE? If you could give some reason for your answer.
I personally think an Indian platform would do a better job if your ultimate destination is India, because you will have easier access to their customer service, to their regulator, than you would to UAE. So right now you have good UAE access, right? So you can keep the money in the UAE arm of Interactive Brokers until you come back. When you come back, I would say have a detailed discussion with a specialist on various things, not just on this, but also on how to strategically plan your taxes, because India has something called the RNOR status, which is resident but non-ordinarily resident. So in that case, in that status, your overseas income is not taxed by India. And before that, also in your last year in Dubai, you can strategically redeem your mutual fund investments or other investments and uh, ensure that those capital gains happen at that point of time, because anyway, UAE does not have a capital gains tax. So I would say do a wider discussion, but specifically on this question, when you do move to India, it makes sense to shift at least some of your money to Indian providers gradually. Again, nothing done in haste or hurry or wholesale, but gradually it makes sense to come into the Indian ecosystem.
So next is from Yash. In addition to Indian brokers like InMoney, please cover other brokers such as Charles Schwab and which option works better for people residing in India. If you can help with identifying US crypto ETF investing, and ITR declaration is already covered. Yeah.
Okay, so other US brokers, yes, Charles Schwab is there, but honestly, I haven't seen too many people use it in India, from India. And I think they suffer from the same issue the Interactive Brokers does currently, which is they're not geared to an Indian audience. So there'll be lots of features which make it inconvenient to you versus doing it through an Indian fintech, which is tailored to an Indian audience, which will provide you automated tax reports, etc. On crypto ETF, you can't buy it under LRS, so don't try it. IFSCA has said explicitly that we will not allow it.
So next is from Sandeep. Can Indian tax resident open USD Euro accounts in GIFT City based banks? Can be Indian or foreign. If so, does it need to mention in Schedule FA? Can the accounts received via LRS? Can IBKR or any other foreign demand trading account be funded using this account?
Yes, you can open USD accounts in GIFT City. As I said, although they are live and operational, banks are not pushing it. Right now, there are no cards that can be issued against it. Visa is in talks with them, but right now, there are no cards. Not sure how good net banking is to access them. So it's think of it like a building. अभी तो construction चालू हो रहा है, foundation बन रहा है. It exists in some form or fashion, but it's not finished yet. So wait a bit. I'm pretty confident that there will be banking products that will get activated in the next 6 months, max to max 1 year, and you will be able to invest through them into your IBKR or other brokering account. It may be that brokers tie up with banks to do something like a 3-in-1. We'll have to see what happens.
So the next question is, for investment through gift, is Demat account needed or not?
No, 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 not at all. For outbound funds, you don't need any demat account. To buy US stocks, ETFs, you don't need a demat. Demat is currently only needed if you want to buy a security that is listed in GIFT. So there's an IPO going on in GIFT, which is of an Indian company. So only NRIs can invest. For them, demat account is needed. Otherwise, you don't need it.
So the next question is from Nimit. Over the past 3 years, I have faced significant challenges attempting to diversify my investments, whether as a DIY direct through an intermediary or as an angel investor. I will appreciate your thoughts on two specific hurdles I have encountered. In any case, I do not intend to exceed the TCS threshold of 10 lakhs per annum as an SIP for diversification, and I'm keen to hear your advice on most logical way forward. Question is investment route में should I pursue the direct LRS route or utilize the GIFT City IFSCA framework? And operational compliance, specifically how to navigate the Schedule FA requirement given the different financial years, Jan to December for US and April to March for India.
Yeah. So that is why I'm slightly leaning towards gift. So as I said, it's a very personal decision, because gift only has limited products right now. So that's the main negative side. The positive side is much easier tax compliance. And as I said, Indian regulator. Um, but if you want to pick yourself stocks and ETFs, then US broking account will offer you a lot more, bigger universe than gift will. So it's a personal choice. You have to weigh the pros and cons.
So next question is from Kalyani. What percentage of total portfolio can be invested in global market usually suggested? Is US tech market good to invest now or wait? Other than US tech, which are the other emerging market which can be considered? Which other sectors like metal, EV, etc. look promising to invest? Uh,
Sure.
for my son who's in Canada, how much he should be investing in India and in global markets?
Okay. So, how much we diversify abroad? The scientific answer is that you should index yourself to the world stock market, the world index, which is the ACWI, the all country world index. And India occupies a very small proportion of that, around 3%. So, technically, scientifically, most of your money should be out. Now, that's not practical for us because India is our home country, our base country. Most of our spending happens in India. So I would say the more practical limit is 30% overseas, 70% India. For your son, since he's in Canada, it'll be a different answer. So I would suggest speaking to us on the call and we can give a more tailored answer to that.
Next is from Sumit. How as an NRI can invest in US markets via India?
Well, there's no prohibition to it. Um, IBKR, so you can go through one of the Indian fintechs, or you can go directly through IBKR. So if IBKR is present in your country, then you can use that local branch. If it's not present, IBKR US will directly onboard you. So you don't have to necessarily go through India. You can if you wanted to. There is no major disadvantage. But do note that outbound funds currently are geared towards Indian residents. So they have fund level taxation, which is tailored to Indian residents. So you might miss out on a bit of return. In case of outbound funds, if your uh, if your country has a lower rate of tax, or if you're not able to get credit for the fund level taxation in outbound funds.
Next is how should we choose the right bank account given the FX spread involved in cross-border transfer?
The right bank account in India or overseas?
So he's an NRI, so overseas.
Okay, I think this needs a bit of detail because we'll have to figure out which country and what the exact context is. So we can take that on the call.
Okay. So next question is what global market focus funds are available in GIFT City along with their expense ratio and key investment rules.
You'll find that in the guide that we will release after. So it's also there in my presentation. You would have seen those slides, but in case you missed them, it's there in the guide. We've compiled a table. But just to sum it up, on the retail side, there is only DSB and Parag Parikh. On the AIF side, there is BNP Paribas, Mirai, Rational Asset Management, uh, Marcellus, and few others.
The next question is from Value Cap. What is the brokerage route for MFDs for global investment other than the mutual fund route?
Yeah, so this could be an interesting way to build additional services for your client. So if your client is looking to diversify abroad, you can tie up with one of the fintechs that enable this. And we will also definitely explore a partnership program. So you can, onboard them onto that platform and help them figure out what the best investment is, how they should diversify overseas.
Next is from Malay. First, Gift City outbound DSP fund has not been outperforming. Any reason?
No, you have to give it time. It's just been 2 months. How can you judge any fund in 2 months? So I say that with a disclaimer that I invested to test it out. I'm not recommending it. I never recommended it. But now would I judge it? It's 2 months. How can I possibly do that? Let's give it at least. I mean, equity requires 5 years. Let's at least look at 3 years before we make any comments about how they perform.
Next is from Jen. I'm curious to know the quite essential for an Indian residence investor aiming to invest globally in 26.
The the what for Indian investor?
Quite essential. So, what is the most important thing to look forward?
Okay. So one thing that will happen is a lot of new launches will happen in Gift City, and we will cover all of those. We'll inform you about them. So that will happen. Bank accounts will get launched, or wallets will get launched. Fintechs will become operational. Zerodha and possibly Grow, and all of the brokers will open their Gift City operations. So a lot of stuff will happen next year. If we speak at this time, end of 26, it'll be a very different presentation, a very different conversation.
So, next is from Kush. Indian mutual funds have set a limit on how much they can invest internationally. Is there an easy way or tool to track in real time how much each fund house has left before hitting the overseas investment limit?
No, unfortunately, they don't even reveal that. There's no way to know how much is left. I mean, you can get an indicator when they announce they're restricting flows to a certain amount, like Edel did with the 5,000 rupees SIP, but there's no way to know.
So next is from Mandar. Is it better to go index fund route or active fund route with respect to GIFT City?
It depends on, in general, whether you believe in active versus passive, where you stand on that debate. So for US market, passives have largely outperformed most active funds. So at least data suggests passive for US market. Um, for other markets, maybe active has some role to play. So it's a bit of a nuanced answer.
So next question is from Blesson. Hi, as an NRE from Middle East, should I first, as a first step, open an USD FCNR account in any GIFT City bank branches to start
Yeah,
investing in any of the GIFT City inbound
yeah,
or outbound funds?
yeah. Yeah, so they are not called FCNR, they're just called FDs. FCNR is an India concept. And it's FCNR is a lot more restrictive. You can't do an FCNR for less than 1 year, for example. Gift City has a lot more freedom. You can do FDs for few months if you want, in a lot more currencies, and you can have savings account in dollars in Gift City that pay you interest. All of it tax free, by the way. Um, at least in terms of India tax, and you can then invest from that into any of the inbound funds that you want. Retail में तो अभी only Tata is active. What Tata does is it feeds into some of its core funds and its satellite funds to give you a diversified exposure into India. So you can invest into that, or if you have enough money, then there are inbound AIFs of many AMCs with for $1.5 lakh. A lot more retail funds will get launched going forward. So absolutely, you can and you should. Like the whole point of GIFT is to make life easier for NRIs, to create a highway into India which doesn't have all of the potholes that the existing road does.
So next is from Nitya. Can a non-resident be a joint holder or a nominee in GIFT City outbound fund? In such a case, if is the fund redeemed when the principal holder is deceased?
We can check that and give you that information over a call. We'll have to talk to the AMCs and ask them.
So next is from Harsh. Tell us how we can easily multiply our spare money and which method is the best way for what size of funds. I'm basically here for a roadmap for 1 to 5 lakh, 6 to 10 lakhs fund investments into US, China, etc.
Okay, so for that amount of money, you may be better off with domestic mutual funds. I mean, feeder funds which have overseas exposure. So there's a list that we are releasing in the guide, which funds have how much exposure to which market, US, Europe, China, etc. So you can use that as your guide. And if you want to get more detailed insights from us, or you want to for us to pick a fund for you, then we are a distributor, so you can schedule a call with us, and we will help you through that as well.
So next is from Abhishek. TCS can't really be adjusted for salaried people as companies don't adhere to these guidelines and also banks don't release the tax challenge before their quarter ends or sometimes even after so many months.
Yeah, there can be a bit of mismatch between the TCS deduction and your adjusting in terms of advanced tax, but it's a matter of few months. Either which ways in the ITR you can claim a refund. Should not be an issue.
Next is from Sandeep. Selling ESOP and moving to diversified funds usage will entail tax, right? Also, can it be done by not moving money to India and investing directly in offshore location?
No, but it'll still entail tax because when you sell an ESOP, you crystallize the capital gain. Uh, there's no way around it. You have to pay tax. The reason to do it is because that one company where you have a lot of money that could come down in a hurry before you know it. So you have to trade that off against whatever tax bill that comes.
Next is from Mega. Is it good time to invest considering the tech stocks cash that we are hoping against?
So I'm personally very uncomfortable with US tech valuations, which is why towards the end I talked about my portfolio for a bit and I don't have that much US in it. Um, but that's a very personal choice. Like I've been cautious on the US for a long time now, and the US has kept rallying. So you have to either agree to deal with the volatility. So maybe they have a crash, but if you staggered your investments, then it won't hurt you as much. Or you put some money into other markets like emerging markets like Europe, etc. So you pick a fund that is globally diversified, like say a DSPS or any other, by way of example. Yeah.
So next is from Siddharth. Can't we do SIPs in overseas funds via vested or in money?
Uh, you can't because of the remittance thing, because SIP essentially splits your money into small installments. So let's say that you try to do a 20,000 rupee SIP. The cost of remitting just 20,000 rupees a month is going to be so high that it's not going to be worth your while. It makes much more sense to remit in one go, let's say 6 month worth of SIP installments. Uh, and then you can keep the money for 6 months in the broking account. So whether it's vested or whether it's uh, in money or whether it's IDKR, you can keep the money there, and then you have to just log in once a month and buy that fund at a set date. So that's a much smarter way.
So next question is the LRS limit is as per the Indian financial year or US financial year?
Indian financial year.
So another question, where does the churn in DSP happen, in GIFT City or outside?
In Gift City, that's the issue with the model that DSP has chosen. Although I'm very confident that they will keep churn low, but to the extent that they have churn in the first 2 years, yes, it will take a bite out of returns. Other funds have chosen the potentially smarter route of feeding into a master fund where all the churn happens.
Next is from Abhishek. For resident Indians, for example, ICICI GIFT City bank account is really useless because money to that account can only be sent via money to one shift by yourself only. Second, you can only transfer money from ICICI GIFT City account to yourself and no one else. So I don't know what's the use of this account, and as of now, they don't have a debit card to offer.
Yeah, yeah, I agree. So that's the thing. They are in theory open and available, but they have not designed it well. There are no cards against it right now. It's like seeing the basement of an under construction building. Like it's not nice. You can't go live there. But it's getting built out. So let's talk again in a few months.
Yeah. So next is from Gopal. Which broker is Neil using for global investment? If we can mention bank, that will be helpful.
Interactive brokers.
Next is from
It's not
Mega.
necessarily a yeah. So just to add on to that, it's not necessarily a recommendation because at that point of time, not all other players were there in the market. Um, Interactive was, just seamless, and they have done reasonably good service. I'm not unhappy with them either, but and my using them is not necessarily a recommendation that you should use them.
Uh, Next is from Jan. Please tell us about high dividend yield ETF opportunities.
Um, Without going into specific names, I would say that if the ETF is declaring a lot of dividends, it's not tax efficient because the dividends will get taxed in India at your slab rate. So if the ETF is just picking stocks which have high dividend yield, then that's different. We'll have to do some research on that and get back to you. So we can do that over the concierge service.
Someone has asked your investment process for the ETFs which you spoke about, which you have chosen for your investment.
Hmm. So as I said, one of my sources of information was the MSCI country fact sheets. If you just type in MSCI and whichever market you're interested in, so MSCI Brazil as an example, it'll give you the fact sheet for Brazil of the last month. It'll give you various things related to the market, the P ratio, earnings, what are the top holdings, and then you can also download the ETF fact sheet, which has a bit more detail on other things like expense ratio and sectoral breakup, etc. And then you can go into those, at least the top holdings. Where does that money come from? So, like in Brazil's case, it's an exporter. It has large miners. A lot of it is dependent on the Chinese economy. So after you go through all of that, you can form a thesis and invest. That's what I did.
The question from Uday. Which are the news sources that one can rely on to find out more about global scripts and ETF?
We will try our best to write as much as we can at the fine print, but I also personally subscribe to the Financial Times. That, of course, is impeccable. It's expensive. May not afford it or want to spend that much, but FT is quite good. Economist, of course, is another no-brainer.
So next is from Mosh. Can you recommend one fund for USA and one ETF for ex-USA? Want to prevent leakages at the time of country rebalance.
Again, let's discuss that over the concierge service because you also have the Parag Parikh gift funds for that. So you might also want to consider that.
Okay. So next is someone is asking for a master class on Schedule FA.
Yeah,
Uh,
we can organize one with a CA. That'll be nice.
yeah. So next is a same question. What percentage ideally overall portfolio should be global?
I've already answered that. Practically speaking, I would say 30%. Scientifically, it should be a lot more, but practically because we live in India, 30%.
Next is from MFD, Shreyas. How MFD can benefit from GIFT City?
So you can tie up with one of the players, one of the fintechs, and hopefully we will enable those tie-ups in the months going forward, where you can onboard your clients onto the platform, educate them about global investing, give them research, and essentially help them protect their portfolios from a purely domestic portfolio. So, uh, yeah, I mean, you would tie up with someone is the short answer.
Okay. So the next is what are the best alternatives to GIFT City for Indian fund managers to efficiently manage and invest in global assets? Example, direct stocks, ETF, bond, while bypassing this limits.
The limits of LRS, I mean, you can't bypass them. Mutual fund investments are not part of LRS, so in theory, you could put some money into feeder funds and some money directly into US broking account, but it's not practical to bypass them. Anyways, $2.5 lakh, it's huge. Why would you want to?
Yeah. So user-friendly and trustworthy platform for for global investment via ETFs.
We've done a comparison of ETF costs. The platforms that we've mentioned are by and large, we've heard nothing negative, very negative about them. So uh, you can make a choice between them. I've personally used IBKR. There's no big issue with it. Uh, I mean, it's very personal. You'll have different reviews from different people. So, I mean, I'm just one person among many users. But costs are objective, right? Numbers are objective. So use our table before you make a decision.
Yeah. So Siddharth is asking what is UCITS ETF?
UCITS ETF is an ETF domiciled in Europe, like Luxembourg or Ireland, which can invest in stocks around the world, in the US or Europe or some third country. The reason why they are interesting is because they are not subject to US estate tax, which a US ETF would be. If your holding in the US is above, I repeat, above $60,000, 60. If you're below that, you have nothing to worry about from US estate tax. So yeah, you don't need to think about usage.
So this is from Harsh. How to find out the expense ratio of underlying assets of fund of funds?
You can go to their website. So let's say that Parag Parikh is feeding into a Nasdaq UCITS fund in Ireland. It'll state the name. If you Google it, that fund will have a its own page where they will state it, what the expense ratio is. Or Morningstar has expense ratios of global funds also.
Next is from Nitya. PPFAS also has an active GIFT City PMS fund, which primarily invests in US and Europe. How would this taxation be since it is direct US stocks?
Taxation will be at investor level. So if they book profits within 2 years, then it will be at your slab rate. And if they book profits after 2 years, then it will be at 12.5% with indexation. Um, what PPFAS plans to do is launch a retail fund on the same strategy in maybe 6 months or so. So if you can wait, you don't need to meet the PMS minimum, which is $75,000. But if you are keen to do it now, then yes, the PMS is very much available and it has uh, the expertise of Parag Parikh.
So the next is what are the GIFT City PMS pros and cons?
The pros are that the taxation is at investor level, not at fund level. So some of these issues I spoke about 42.7% fund level tax in the short term, that won't apply to a PMS. In PMS, it's just your slab rate. Um, and after 2 years, it's your long-term capital gains rate. The cons are that Schedule FA exemption will not apply to a PMS because the underlying holdings are in the US. Um, Also, US estate tax exemption may not apply because, again, the underlying holdings are in the US.
So next is how can an OCI, say US-based realizing more than 1 million on sale of immovable assets in India, use the GIFT City route favorably to safeguard against dollar depreciation and for reasonable returns.
So you can transfer money from your NRO account. So let's assume that the proceeds from selling this immovable property come into your NRO account. So as long as you get 15 CACB certificate, you can remit money from there to your GIFT City account and earn dollar interest rate over there, which is not taxed in India, and invest in funds over there. As long as you're NRI, you have all the inbound funds available to you. Uh, so that's how you would do it. Again, if you need help, we do have the concierge service to help you.
Question is from Abhijit. While it's good to know that there are various options available from a long-term 5 to 7 years point of view, does it make sense to invest in ETFs like VOO, SCHD for a conservative investor above the age of 60?
So VOO is S&P 500. It depends on your risk appetite. If you're willing to take that much risk, it's your decision. I mean, it's not a it's not like you're buying a crypto ETF or a meme stock, right? It's the S&P 500. But I mean, it's better discussed sort of over a call, depending on the other parts of your portfolio, whether this makes sense for you or not, and whether you should do it through gift or directly buying VOO.
So next is from Yash. Are there any regulatory issues if an investor puts money into crypto ETF by international brokers not registered with IFSCA, such as Charles Schwab?
There could be, because IFSCA has taken the position that uh, crypto ETFs are not permitted under LRS. So why would RBI take a different position? Why would you risk it? Don't do it. You can, if you really want crypto, you can buy it on an exchange in India, which is registered with FIU.
So next is from Raghav. Are there any ways to invest in global hedge fund products while being Indian tax residents and an accredited investors?
No, because hedge funds use leverage, and leverage is not allowed under LRS.
Okay. So next is from Amiya Kumar. For question, if someone who has been in an MNCs with RSUs from them and he is an Indian resident, can he move his fund from after selling the RSUs to Gift Dollar bank account, and can he invest directly through Gift City diversified funds, and how?
Yes, yes, you can. So the only condition is that don't leave the money idle for 6 months. So if you sell your RSUs, you can move the money to a gift. Um, of course, if you're a resident, then gift accounts have not really been enabled very well. So the glitch is over there. Um, if you wait a bit, I think this will get fixed, and this should be possible where you move the money to a gift account first, and then into a fund and gift. We are talking to banks. As soon as we're able to figure out a good solution, we will let everyone know.
So next is how can we invest in MSETFs or various countries like you did? Is it through AIF or how?
Or you can do it through a US broking account, like I did through Interactive, or you can do it through Vested, or you can do it through any fintech or broker that you go with. You don't need an AIF. I mean, you can use an AIF if you want to, if you want the professional management, but AIF ticket size is $1.5 lakh.
So next is Gurpal. Can we invest in usage via Vested?
I don't think so. They have enabled something called global funds, uh, which has some active funds. UCITS ETFs, as I understand it, are not yet enabled on Vested. So um, you might have to wait a bit for that. I think they do have plans.
Does all Indian brokers give portfolio details as per Indian tax laws for Schedule FA? reporting purpose?
The Indian fintechs do. So Vested does, for example. I think InMoney does. Um, so you are better off generally with them than with purely US broker.
So next is from Sunny. For NRI who want to invest in India growth story, what are all the ways to invest to avoid INR depreciation? All inbound in gift don't help as they ultimately convert funds to INR and they convert to USD at the time of redemption. My NRI clients has invested in multiple inbound funds through gift like HDFC, Mira, Nippon during last few months. All of them are negative through Indian markets are positive. The INR depreciation is eating away all the returns. What is the alternative for NRI who are positive on Indian growth story?
There isn't one. A gift does not solve for INR depreciation. What it solves for is TDS. So there is no TDS or tax in India. It also solves for conversion. So your client's money, when they're moving it from US to gift, does not change currencies. It remains in dollars. Yes, the underlying does change currencies. And so you do face the rupee depreciation impact, and there is no way around it. If there is an India growth story in the picture, you can't get away from the rupee. My only thing would be then don't have that much faith in the India story and put some money in other countries as well.
So, question from Viral. Is gold a replacement to US stocks funds?
It is, if you think about it, right? I mean, the Indian masses who don't have access to US stocks or ETFs or broking accounts, their only hedge against rupee depreciation is gold, and they have been so savvy about it. Our mothers, our grandmothers, for generations, they have bought gold, and they have stuck with it. I mean, there have been equity market champions among millennials and Gen Zs telling their parents, "ये आप क्या कर रहे हो?" But that advice has not been heeded. They have bought gold because it's the wisdom of the ages. I mean, it's been their hedge. There,
Yeah, sorry. Next is from Gaurav. If I have to invest global funds via Gift City, can I do through Zerodha for Indian MF? Is InMoney or Vested the right platform and do they provide direct investment or regular investment?
for gift funds, they provide regular investment, not direct. Zerodha, we don't know. They haven't launched yet.
Next is, are there any
But
remedies?
but if you want direct investment into, let's say, DSP, you can just do it through their website, DSP IFSC.
Next is, are there any remedies for violation of the 180-day rule?
You can go to RBI for compounding.
Next is Yash. What is the better for Nasdaq index investment via Indian index fund or via ETFs on InMoney?
Mm, Indian index funds, feeder funds, as I said, are not open, most of them, or they have very small limits. Uh, Through InMoney, you can directly buy, let's say, an SPY or a VOO or any of the others. You have a wider universe available to you. If you want the benefit of easier tax compliance and Indian regulator, then you now also have Parag Parikh. They have uh, funds that feed into S&P 500 and Nasdaq.
Next is, will a joint account in IBKR with my spouse help avoid the US estate tax problem? Or will the estate tax of 40% still apply to half the portfolio?
It's a jugaad, it's a practical solution. So what people do is they open joint accounts and then they don't tell the US that one of the partners is passed away. The other partner withdraws everything. May work for you. It's a legal risk. So nothing further to say on that.
Next is Abhishek. ICICI Gift City net banking for resident is pathetic than a 15-year-old.
For residents, yeah, I'm not surprised. I'm not surprised. Just give it some time. Somebody will solve for this. We're also trying our best to help.
Okay, so Sunny, my NRI has invested in multiple. Oh, sorry, this is the same questions. Next is Naren. I am in the Merchant Navy. I am an NRI but based in India. I have a NRE NRO account. Am I allowed to invest in international stocks? Will it come under LRS or any other regulatory issue I should be aware of?
No, it will not come under LRS if you're an NRI. So you can very much invest. There is no prohibition.
So next is from Anil. Parag Parikh S&P 500 Fund of Fund and Nasdaq 100 is open yet for subscription, or will it be launched in 4 to 6 months?
Offline is. So if you go through a distributor, then you can. And that will include us in as soon as a few weeks' time. And online, I think will start from Jan.
So next is from Chirag. I had some shares of a company which was in Equate Plus account. Now I wish to sell my shares and transfer the shares to IBKR. I have added interacted brokers to my Equate Plus account as a US domicile. I now come under the purview of US taxation. So he got a mail saying you have been identified as a potential US person based on information provided in Equate Plus. You are considered a US person if you have United States citizenship or a US bank account or an address. These have several implications. Your share or stock option holding will be subject to 1099 US tax reporting. Form 1099 is used by the US
Okay.
Internal
Okay.
Revenue Service.
Sure. So this is should be discussed over call. Sounds a bit complex.
Yeah.
Normally, for Indians who invest through a US broking account, there's a form called W8 BEN, which certifies you as an Indian resident. So some people may not have ticked that. You might have forgotten to tick it, and therefore you got slotted as a US resident. So there would be a fix to it, but we'll have to figure out over a call.
For the concierge service, we will be opening this more slots sooner, so you can book it for the same. Next is from Nimit. Did you face any IT issues in India with your Schedule FA? I have heard only horror stories. Same with PMX expense deduction as well.
Yeah, thankfully not. Been very conscious with Schedule FA, but I've heard horror stories, so you have to be careful.
Resident Indians can buy crypto directly via CoinDCX, but not crypto ETF. Why?
Because under LRS you can't. So domestic exchange is different. That's just the way the rules are.
So last of few questions. Next is from KUR. Can resident individual trade US OTCs for short-term opportunities? Also, is it advisable to do machine learning based trading for US stocks for a resident individual?
No and no. So if there's any hint of leverage, you can't do it. Second thing is, so OTCs may or may not be leveraged. It's hard to answer that question, but if there's any hint of leverage, you can't do it. And trading, I mean, you can do trading in the cash market, but if you run up a big tax bill, it's all slab rate, unlike India, which is 20%. So generally, you diversify overseas to invest, not to trade.
So next is, what are the tax implication in short term and long term for investing through investing apps? And what does this short and long term mean from an Indian STCG and LTCG duration?
Yeah, 2 years, very simple. If you buy something, try not to sell it in 2 years, then you'll be into long term, 12.5%.
As a former NRI with significant US exposure via DBS Singapore, should I keep holding and adding there? Or is there a strong case now to shift incremental global investment to GIFT City?
Um, there is a good case for it. For example, the interest rates on Gift City accounts for NRIs are quite good, 4.5, 4.75, possibly much more than what you get in Singapore. If you want to invest in India, then Gift is an easier way. It doesn't take care of rupee depreciation, but it does take care of TDS. It does take care of ease of transacting. So for that also, US Gift is good, and more options are coming up in Gift. So you can explore a little bit into Gift.
So next is, which of the two options will you recommend for investing in S&P 500 or Nasdaq 100? Sell RSUs, move money to IBKR and invest in UCITS ETF, or move the money to Gift City and invest in Parag Paring outbound fund. Expense ratio wise, which is lower?
Expense ratio wise, the usage could be slightly lower. So remember, Parag Parik is uh, zero point 0.3 on direct 0.6 on regular, so it's not by any means steep, but you will obviously get a lower expense ratio uh, with the usage ETF. The benefit of Parag Parik is twofold, as I said. One is from an Indian tax compliance point of view, it's not in Schedule FA, and second one is you have an Indian regulator to safeguard your interests.
So the next is there an ETF or usage that is tracking global one index excluding India?
Uh, yes, you'll have to search for it, but there are many ETFs which are called X something. So, XYZ X US ETFs, XYZ X India. So there would be, yes. We can help. If you schedule a call with us, we can do some research and help.
Okay, so the last question. If I apply for PPFA as passive S&P 500 fund, is there any specific reporting I need to do on taxation front, or is it same as domestic mutual fund?
Same as domestic mutual fund. In fact, maybe a bit better also because when you withdraw, the money is exempt. The fund has already paid tax.
Yeah. So one question, Parag Parekh via distributor is considered direct or regular?
Regular. If you do it by distributor, it's regular. Difference is not huge, zero point 0.3 versus zero point 0.6. But yes, that'll be regular.
Okay, so one last question which pop up. Given the gift simplifies execution and TDS doesn't solve for currency risk, how would you suggest investors decide between gift versus an existing offshore account for incremental investment? Is there a specific portfolio size, holding period, or investor profile where gift clearly becomes the preferred one?
Um, so gift does solve for currency if you're doing outbound. The currency thing was inbound. So I had answered the question of an NRI who wanted to invest in India. And that, I mean, no, I mean, even if you do it through a ETF listed in the US, which invests in India as an FPI, you would still face currency depreciation. I mean, that doesn't go away from any India exposure, however you take it. If you're doing outbound, then GIFT does solve for currency, as so does an overseas broking account. So that's not a differentiator. Differentiator is twofold for GIFT. As I said, Schedule FA compliance goes away, and you get an Indian regulator.
Yeah, that's it.
On the flip side as well, in a broking account that you open, you get more choice if you want to. Today, buy an Indonesia ETF, for example, it won't be there in GIFT, but it will be there in an IBKR or a Vested Finance.
Okay, so that's it, Neil. That's all the questions which we had.
All right. All right, folks, thank you so much. Very, very patient and kind of you to stay with us and take the effort to understand this complex subject. It's not easy. Um, it's very easy to accept a narrative that's floating around social media. This stuff requires a lot of research and effort. So thank you for participating in this. Give us feedback, um, use our concierge service, and I look forward to a very, very different gift in a year's time.
Yeah, we will be sharing the recording as well as a presentation. So don't worry on that part.
All right. Thank you so much.
Yeah, thank you. Thank you, Neil.